growth companies outperform value investments. It's pretty ironic to me that companies with net cash positive on their books that sell at about 10, 11 times earnings at a discount to the 14, 15 times earnings of the market, it is ironic to me that these companies are not selling at a premium of about 11 times earnings. In 2019, investors are going to start paying a lot more attention to value investments. Companies with a pristine balance sheet, strong free cash flow, selling at discounts to the market multiples. One company, such as Bristol-Myers, and in fact they did purchase Celgene at $74 billion. After the purchase of Celgene, the multiple for this company in 2020 is actually less than 8 times, because Celgene is going to help them generate about $45 billion in free cash flow in the next 3 years. Both of these companies specialize in immuno-oncology, where they have drugs in the marketplace that harness the body's immune system to fight cancer. Based on the purchase price, Celgene should be selling today at $97 a share, and yet they are selling only at about $87 a share. Not only that, there is another $9 a share for the Celgene shareholders. If 3 of their drugs are going to be approved by 2020, 2021, the Celgene shareholders will get additional $9 a share. If and when the hunter becomes hunted, there will be a company that will come in trying to buy Bristol-Myers itself. Bristol-Myers might not have a chance but to scrap off that deal, and the deal is not going to come through. I think Celgene looks very attractive, selling at 10 times earnings, even after that purchase price. One caveat about a situation where that deal will be scratched off, if that is the case, then there is a termination fee of $2.5 billion that will go to the shareholders of Celgene if that deal doesn't come through.
Let's talk a little bit about Apple. They're currently spending about $10 billion a year, which they're going to put an effort into building a car, but they've made a pact with Volkswagen is going to produce some of those early cars. The market is expected to be a $2 trillion market if they really can launch this. They're expecting that to happen within the next 5 years. That's where they're putting all their energies, because that was one of the last things that Jobs talked about wanting to do. He saw that as the next big front. But the $6 billion of miss on their top line, if I just take that dollar for dollar off of free cash flow, all that means is they're going to have 50 plus billion dollars in free cash flow this coming year versus 60.
Because I think that Apple, with their piles of cash, $130 billion on their books net of debt, can easily also look to buy a company that can add some strength to their subscription model. They already sell on a subscription about $37 billion every year in services. Tim Cook said that this year they will try to become net cash neutral, meaning they're going to try and spend that extra cash they have on their books, which is $130 billion. So how can they spend it? They can spend it by increasing the dividends. They can spend it by buying back shares. They can spend it also by buying a company. There was a story over the weekend trying to identify one of these companies, and that company is Nintendo. As we speak, has about 20 million Switch devices on the street. The idea was try to use the ecosystem of Apple that has 1.4 billion devices out there that can launch a lot of the games that Nintendo created in the past 30 years. Mario, Zelda, Donkey Kong, they have a library of thousands of games out there. So you can make a case that a company like Nintendo, that is down about 40% from its recent peak, sitting on $9.6 billion in net cash, has a pristine balance sheet, gushing profits of about $13 billion in sales every year, fits into these parameters and can help now Apple become more of a subscription model as opposed to selling iPhone units and other devices. They also use the same ARM microprocessor chips that Nintendo uses. So it's not a big shift for them to make that leap.
So keeping an eye on the yield curve. Again, that's our one of our leading indicators of potential recession issues. 3-year to the 5-year has stayed right about 1 to 2 basis points. There has been some good fluctuation in the 2-year and the 10-year. Temporarily last week went up over 2.74, which was higher than it's been in a while. But at the end of the week, still ended up right around 16 basis points. So still not showing a whole lot of move in either flattening or ingression. So still something we need to keep an eye on.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like our videos, please become a subscriber on the YouTube channel. You can also check us out by looking at our website at tamarsecurities.com. You can also reach us directly at our main offices in Woodland Hills by calling us at 818-914-7461. The highlight of the week is that after 9 years of seeing growth investments outperforming value investments, the markets are becoming so volatile and investors are paying more attention to valuations. Value can now start outperforming growth.